Joining us is Rosenberg Research founder and president, David Rosenberg. David, welcome. I mean, these are the kind of numbers that you have been expecting to see for a while now. Weaker headline job growth, higher unemployment rate, weaker wages. What do you think it signals about where we are?
Well, I think that it does signal a significant loss of momentum, which is, I guess, a no-brainer considering that we came off 4.9% GDP in the third quarter. The Atlanta Fed, I think, really kicked things off, Sarah, cutting its number down to 1.2 for the fourth quarter. So if you believe that number, you had to believe that employment was going to follow suit. So today's number didn't surprise me. I think the downward revisions really help explain why we had that outsized, but really what proved to be an artificial run-up in the previous 2 months. But I think that the economy is losing momentum, and I think that the people that threw away the recession call into the garbage bin because it didn't happen yet are going to be putting that call back on in the opening months of next year.
They're not yet. I mean, we talked to Jan Hatzius in the last hour. We talked to Tom Barkin of the Richmond Fed. There is still a feeling, and I think you're seeing it in the market too, and certainly in the equity market, David, that the economy can come in for a soft landing. If the Fed is done raising rates and we continue to see progress toward a bit weaker economy and lower inflation, that doesn't necessarily mean we're going to head into recession.
That's today's narrative. Firstly, the recessions always start after the Fed is finished with this tightening cycle. The recessions don't usually occur while the Fed is still tightening. And so those are the lags. And actually, I think those of us that were wiping eggs off our face because we were calling for recession a tad too early, it reminds me a lot of what I was saying back in 2007. I was early to a fault. But the recession came in December of that year. I mean, to say recession is not going to come after the most pernicious tightening cycles since 1981, to me is a low odds bet. The reality, when you look at the historical record, is this. The recessions actually start 2 years after the Fed's first rate hike. And the Fed's first rate hike was March of 2022. So that puts a bullseye on this business cycle in the first quarter of next year. I would say that, we're building up towards it. We've been in a soft landing. I don't think a soft landing is a permanent state of the economic cycle. The soft landing, which can last a year, and we've been in a soft landing, but the soft landing historically is just a bridge between the economic expansion phase and then the contraction phase, which I think will be next year's story.
You remind me of Deutsche today, David. They write, we've been in the hard landing camp for almost 2 years. That said, the economy's been resilient. If we get through Q4 and Q1 without it occurring or pointing that way, we have to question whether our indicators are relevant in this cycle. Would you agree it has to be done in the next couple quarters?
I would say that 100%, that if we don't start seeing it by the first quarter, then I guess we'll all have to just pen a report called "The Business Cycle's Been Repealed and Interest Rates Don't Matter." But, the reality is that, it's like back in 2007, I'd be on your show and you'd be saying the same thing. Where's this recession you've been calling for? But, back then, the Energizer Bunny, called the consumer, had its battery extended because of mortgage equity withdrawal and cash flow refinancing, the last vestige of the housing bubble. And that kept the consumer going until it didn't. And remember, the recession started in December 2007, and not even the Fed saw it. And really only me and Dick Berner on Wall Street actually were calling for recession back then. And this time around, the lags have been extended because of the last vestige of the fiscal stimulus that was unveiled back in March of 2021. But the reality is that, as Powell keeps on saying, these things operate with lags. I was very encouraged today. I guess if you're saying, why would the stock market rally and the bond market rally? Well, I think that both markets just love the fact that the wage number at 0.2 and the 3-month trend is getting down towards 3% at an annual rate. And, we got the unit labor cost number. Nobody talked about the productivity. Unit labor cost number in the third quarter, negative 0.8 sequential. So the big concern that we're going to have this wage price spiral with or without UAW strikes or other strikes, that the wage numbers are actually decelerating very nicely. And I guess you could argue that's good news for both asset classes.